Welcome to Oregon Cash Flow Pro. My name is James Barber. As always, I'm here to help you maximize your cash flow. Today, we're just going to go through and look at the comments that people have left recently. Lonnie had said, should she buy the least amount of insurance the IRS allows, pay for it in the shortest time allowed, 5 years is what she had in here, for an IUL to be structured properly. Her goal is cash accumulation for kids' college tuition, not death benefit, which is what an IUL should do. If she could only afford to invest $20,000 a year, would it be better to max fund 2 policies, with each policy being $10K per year, for 5 years with the least amount of death benefit? So each policy would have a total of $50,000 premium. Or she gets another way to ask is, if she only has $20,000 a year to invest, should she stop funding at 5 years so it can switch to option A? So there's a little bit of a misunderstanding from whoever she got this information from to begin with. So the shortest time allowed is not 5 years. That is not the shortest time allowed. When it comes to your MEC limits, remember, 7 years is our MEC test. So if you are funding it at $10,000 a year and that's your MEC limit, you could fund it for an additional 2 years for that same amount before you can make any reductions. So you can actually get $70,000 in. If you have a set amount of money to move into a policy, 5 years might be best balance between expenses and potential growth. But it's not the shortest time period allowed. And you could potentially put all of that money in 1 year. And that might be the best way to go about it. We talked about that at the beginning of this video. That could be the best way to go about it if we knew what the index was going to do. But we don't. So we have to do a balance between the expenses and the potential growth. 5 years is a good period for that. So I don't have any issues with the 5-year period, but we want to make sure that we understand it's not the shortest time period allowed. Okay. Now, the least amount of insurance, yes, that would mean the MEC limit to allow for a 5 pay. That's totally fine. I think that policy would be structured just fine with what she's describing here. Now, next question. Would it be better to max fund 2 policies, each one being $10K, with the least amount of death benefit? The answer would be yes if you're getting a traditional design. So one like Doug Andrews does, where he does not reduce the agent commission. They don't do a split design where they blend in some supplemental term, and you have an optimum design where, let's take Allianz as an example. Allianz allows us to do a 10-to-1 split. 100,000 base face amount, that's the commissionable insurance. And we can blend in 10 times as much. So we can blend in $1 million with that doesn't pay any commission. So we have a total death benefit in that case of $1.1 million. That's our scalable amount. You could have a $50,000 MEC limit with that one policy that pays out a commission based on a $100,000 death benefit. That's going to be more efficient for putting in $50,000 a year as opposed to doing 2 policies at $25,000 a year, where you have $100,000 base in each of those 2 policies. So we doubled the commission essentially to go with 2 policies. That same thing would happen with this type of design. So we know with Allianz and with most of our carriers, there's a $100,000 minimum for that base face amount. And that base face amount determines the commission. If we do 2 policies to have a $10,000 MEC limit, we might only need $250,000 in death benefit. That means we have $100,000 as our base face amount, and we blend in an extra $100,000. And we do that for 2 policies. So we're doubling the commission to have 2 policies in that situation. It may not be the best way to go about it, to split it up at $10,000 per year. It's a lot easier when I meet with this person, I show them, because I can actually show them, okay, here, look at this. If we put in $20,000 per year in one policy, as opposed to $10,000 in 2 different ones, here's your potential savings. Now, it might be worthwhile to still go with 2 policies because there could actually be a death benefit need. If they don't already have death benefit coverage, then it's a good idea to have some coverage on both parents, which would be the case if you did 2 policies in this. It could be worthwhile. And because we do a reduced commission design of a policy, it's probably still not that big of a commission. So even though we're paying double, it might still be reasonable enough to to go with 2 policies as opposed to 1. But it's not the most efficient way to do it. And one of the things that the people I meet with often hear is, after I show them this is the most efficient way to do it, I show them you might not want to do it that way because you might have a need for a death benefit on each person. But my goal is that they make that decision based on knowing the differences, knowing what goes into that and the actual cost, not me making the decision for them by hiding information, basically. So that's just the way that I do business, right? I want to make sure that you have the tools to make the right decision for you. Now I can give you some advice, and you can ask for my opinion, which one you want, or which one I think you might be better off doing. Or ultimately, you go with what you want to do and not necessarily what I would recommend without knowing why I recommend it.
Hope you found value in today's video. If you'd like to find out more about IUL and whole life, check out these videos right over here, and we'll see you next time.
Now go maximize your cash flow.
Lonnie had said